this video is for the work together and on your own for 2-3. First thing I wanted to show you though is a little bit of a cheat sheet that I have made and that you should also make for yourself as well, just to kind of help you out. So I have on here assets and then normal balance, liabilities, their normal balances with arrows. Remember, assets is cash, prepaid insurance, accounts receivable, and supplies. Those are the only ones we've had so far. Liabilities is your accounts payable. And then I put our owner equity related accounts on the right side. So capital would be our owner's equity we have that has a normal balance as a credit. And that is because capital increases our owner's equity, which would be increasing with a credit here. Now drawing decreases the amount of our capital account, so it's opposite. Drawing has a normal balance of debit. Sales also increases our owner's equity, so it also increases the same way that capital does with a credit, and our expenses also decrease, just like our drawing account decreases our owner's equity, so that will also have a debit normal balance just like drawing. But if you make a sheet such as this, it will help you, something you can reference to kind of help you out as well. So our work together for 2-3 is on page 49 in the textbook, and it's also on page 27 in your workbook. We're going to use the same accounts that were listed and the 2-2 work together, so you can reference that in your textbook as we need to. So first transaction on March 11th, we sold services on account to Johannes Erickson, $125. Our two accounts for that will be accounts receivable. I'm going to abbreviate for right now. And this would be an acceptable way to abbreviate accounts receivable. She did not pay with cash. She is charging on account, and we sold services. The account title we will use for that is sales, which is classified as a revenue account. All right, accounts receivable is an asset, and assets have a normal balance as a debit. The amount that she owes us is increasing, therefore accounts receivable will receive a debit of $125. Now sales is a revenue account. Sales has a normal balance of a credit, so to increase sales we will need to give it a credit of $125. Our next one on the 13th, we received cash from sales, $260. We received cash, so we know cash is one of our accounts, and this was for sales, so sales will be our next account. Cash is increasing since we received cash, and cash is an asset, so in order to increase our cash account, we need to give it a debit of $260. Sales is a revenue account that affects owner's equity. Therefore, sales will increase with a credit, since that is how our sales account increases with a normal balance of a credit. So the only difference between these two is that the first one on the 11th, they paid on account. They charged it basically to themselves to pay at a later date. And in the next one, they just paid for cash. Sales, however, is still the same. On March 14th, we paid cash for our telephone bill. So we have two accounts for that. I'm going to write cash second here. And what we need to do is for our telephone bill. So how do we know what account we need to use? If you go back in your textbook on page 42, you can see the different accounts that we have for this. And it's going to be an expense because this is something we're paying to keep our business running. It's a normal operation of running our business. And so after sales, we see rent expense and utilities expense. So paying cash for our telephone bill is going to be utilities expense. you have to write expense after it. It would be incorrect to leave out expense. All right, let's look at expenses here. Expenses have a normal balance of a debit, it's opposite of sales. That's going to be the same as drawing because it's decreasing our related owner's equity account. So expenses are increased with a debit. So for this one, it's $54. And cash, we are paying cash, which needs to be decreased with a credit. All right, on the 16th, received cash on account from Johannes Erickson, $125. Our two accounts will be cash and accounts receivable. Dash Johannes Erickson. So we received cash, which means our cash is increasing. Cash is an asset, and assets increase with a debit. So cash will receive a debit of $125. Accounts receivable is also an asset. The amount that Johannes owes us is decreasing because she's paying on account, so she will owe us less money. So this asset account will be decreasing with a credit. And just remember, our debits and credits have to equal. I can't have two debits here of $125. That would make our accounting equation not in balance, which would be a problem. Our last one for the work together, paid cash to owner for withdrawal of equity, $200. So this owner is taking cash out for personal use. So we'll have two accounts for that. We will have our drawing account, and I will need to look back on page 42 in the textbook to find the drawing account for the name. I can't remember his name. John Jensen, drawing. And he is withdrawing cash, so that will be our second account title. The drawing account is opposite of our capital. Our capital is when the owner is investing money into the business. The drawing account is when they take money out of the business. So John Jensen drawing, since he is withdrawing, that's going to increase the drawing amount, the amount that he has taken out of our business. So the drawing account will receive a $200 debit. Cash, we are withdrawing money from the business, so cash is decreasing, therefore cash will receive a credit. So a few more accounts that we have on this one as well. I'm going to flip it over now and do the on your own. So this is on page 28 in the workbook and on page 49 in the textbook. I'm going to jump right in. First transaction, we paid cash for rent, $800. So let's look back on page 42 in our textbook, and we can look at our expense accounts that we have, because we need to know we're paying cash for rent. What would rent be? And if we look back, we have advertising expense and we have rent expense. Oh, it's probably rent expense. That makes sense. So our first account title will be rent expense. And we paid with cash, so that will be our second account title. Now, paying with cash doesn't mean we're actually paying with dollar bills. This would be like writing a check. It's taking cash out of our checking account, for example. All right, expenses have a normal debit balance, since they are, basically it's decreasing the amount of our related owner's equity. But rent expense, advertising expense, those are all expense accounts. Like sales is classified as revenue, expenses are classified as expenses. They are, however, related to owner's equity, but we don't record them all in owner's equity because that would just be we'd have a lot of transactions related to capital and we wouldn't know what they were all for. So this is a better way of recording it. So expenses are increased with a debit. We paid $800 for rent. Cash is decreased then with a credit. Remember, cash is increased with a debit, decreased with a credit. On June 14th, we received cash from sales, so I will record cash and then sales. We received cash, so cash, this asset account is increasing by $68. Sales is a revenue account. Our revenue is increasing and it increases with a credit, so we will record $68 credit. On June 15th, we sold services on account to Theo Moses, $130. So we sold on account, he owes us money, so I'm going to record accounts receivable dash Theo Moses. And then sold services is just another way of saying sales. Accounts receivable is an asset account and it's increased with a debit. So the amount that he owes us is increasing, so he will receive a debit of $130. And we made a sale just like with cash previously, however this one's on account. Sales is increasing and sales increases with a credit. On June 18th, we paid cash to owner for withdrawal of equity, $280. So we have cash, and if we look back in our textbook to page 42, the account we will use is Brian Helfrey Drawing. And he has withdrawn cash. Our drawing account is the same as expenses. It is decreasing our related owner's equity account. Drawing is an owner's equity account, same as capital is. Sales is revenue and expenses are expense accounts. So Brian Helfway Drawing is increasing the amount that he has withdrawn from the business. It increases with a debit, and he has taken out $280. And our cash is decreasing, so it will receive a credit of $280. And then on the last one, on the 19th, we received cash on account from Theo Moses for $130. So I will put cash and then accounts receivable. If you abbreviate payable, you would just put PAY, period. But make sure you are writing these accounts correctly. You can't just write accounts receivable and you can't just write Theo Moses. That would be incorrect. So we received cash, so cash is increasing with a debit of $130. And accounts receivable, this is also an asset, same as cash. The amount that Theo Moses owes us is decreasing. Assets decrease with a credit, so we will record that as a $130 credit. Now, just to end this video, I am going to zoom out my camera here. So please excuse me while I do this. There we go. You can see just about everything. So this is my little cheat sheet. I have an extra T account here on accident. Maybe I'll just go ahead and write debit on the left and credit on the right. I just drew one too many as well. So assets, liability. The capital and the drawing account, these are both owner's equity. Sales is revenue. This is their classification. And then all expenses, they are expenses, which seems weird to abbreviate expenses as expenses, but there's many different types of expenses, though. You can have advertising, rent, and so on and so on. So that's how they are classified. However, though, with capital, one thing that's helpful to know is capital is increased with a credit. That's increasing our owner's equity. Drawing would be decreasing the owner's equity here with a debit. So since capital increases owner's equity with a credit, sales also increases with the credit. Since drawing increases the drawing amount here with a debit, which actually pulls away from our owner's equity, but drawing is increased with a debit, same as expenses. Those are both the same. So if you make a sheet like this, it would be really helpful to you as you go throughout your transactions.